Okay, we're going to get started with this third episode of the Discerning Distributor. Thank you so much for taking the time out of your busy days, as always, to join us and to educate yourself. I am so excited about today's webinar. I've got a fantastic guest in Anthony Smith from FreightWaves. We're going to be talking about the macroeconomic landscape with a specific focus on Capex, on inventories, on different considerations that distributors and manufacturers need to think about when it comes to investment, both for the latter part of this year and into 2023 and beyond. And we're going to really dig into the things that you need to contemplate as you think about planning and budgeting for next year and beyond, especially in light of the latest increase by the Federal Reserve in the interest rate policy, another 0.75% increase in the federal funds rate, and the implications that that's going to have to all of those decisions. I am very happy to have Epicor as the sponsor of today's webinar. It's a company that has been helping thousands of wholesale distributors integrate all their business functions into one enterprise resource planning or ERP system for over 50 years. Because of their deep experience in the distribution business, they get you and your unique distribution challenges. Their ERP solutions were designed with distributors for distributors. That just means that their solutions are built specifically with the right functionality for the distribution world. They're ready to use out of the box without complex and expensive customizations. It's one of the top reasons new customers tell Epicor they selected them for distribution solutions over others. You can learn more about Epicor at epicor.com/distribution. With that being said, I would love to introduce you to my guest, Anthony Smith. He is the chief economist for FreightWaves, the leader in providing global supply chain market intelligence. Anthony heads up macroeconomic outlook and trends forecasting throughout the US. He brings years of experience and diverse background in forestry, technology commercialization, economic consulting, media, and building products. With that, Anthony, I'd love to invite you to join me on video here and engage in a fascinating conversation. Thanks for being here.
Alex, it's an absolute honor and pleasure. Thanks so much for having me on.
My pleasure. Well, I am sure our audience can't wait to ask you questions. They can do so by leveraging the Q&A tool at the bottom of the Zoom meeting here. But I'll start off being the host. I get that privilege. We've talked a lot about the macroeconomic landscape on this show before. Things obviously continue to evolve and change every single day. New data comes out. I know you guys have some great data sets at FreightWaves that you leverage on an everyday basis. And so I guess my question to you is this debate that's raging, whether we're in a recession, whether we're heading for one, what factors or data would you look at in terms of determining that and kind of where we're headed in the future? And what is your personal opinion, whether or not we're in recession or not? I'll open it up to you with that.
Definitely. So I'm a bit old school, and of course, when I look at GDP for 2 quarters and it's declining back to back, I'm saying, okay, recession. Although, I think there's a great case and great argument for saying, hey, the GDP may not be the best gauge or measure for overall U.S. growth or how well we're actually doing, because we've shifted so much and our economy is a little bit different over the last couple of decades. But the other big thing is that, as you know, many different sectors can be in a technical recession or in a down business cycle, while others could just be thriving at the same time. And I think that's where a lot of the, debate kind of comes from, because we're seeing growth in some areas and strength and, perceived strength in other areas, especially in the jobs market, that are propping up certain sectors that are saying, hey, this isn't a recession. And I think, it's technically a recession, and if we see an upward movement in the third quarter, I'd say, okay, no recession, no more. But I don't think we're out the woodworks just yet. But what we've seen, though, is, as I mentioned earlier, that, some segments can be in recession while others thrive. We are currently, I think, in the early stages, or in the midst of a freight recession. And we've had a freight recession in 2019, while the economy just kind of, continued to grow and expand. And so this freight recession, I think, is going to be very much more pronounced and more, I think, apparent to everyday consumers and those that are operating outside of the supply chain.
That's fascinating. So when you're talking about freight, are you talking about business to consumer type freight? Is it more in the B2B space? Can you expand on that a little bit?
Definitely. So when we're looking at a freight, it's going to be more so we're looking at volumes. That's one big thing. And what we've seen is that volumes on a year-over-year basis are down over 20%. And that doesn't seem that out of the world, seeing as how we've had such a ramp up throughout COVID-19, throughout the pandemic. There's just, of course, stimulus packages hit. You have increased spending after those packages were deployed from the consumer. And now you see a huge demand in freight activity. And now there's this huge demand for goods coming through. And now you see that there's so much rise in freight rates. And so you see the price for freight to just kind of start to skyrocket, because for so long, it's kind of been a back office, conversation with transportation for a lot of suppliers and a lot of shippers. You just say, hey, I make goods, I produce goods, and then, let, our logistics department deal with it. But now it's become much more of a forefront thing. And so I think now what we're seeing is there's been so many people entering the market for logistics, whether you decided to join a carrier, start your own brokerage, maybe you have a freight tech solution or anything like that, or some type of something to ease the process for those that are really going through this supply chain bottleneck that we've seen over the last couple of years. Now, with so many entrants in the market, we're seeing that transportation capacity is just kind of skyrocketed and rates are dropping and plummeting. And now you're seeing the seesaw effect of oversupply of transportation potentially. And now you're starting to see contract rates start to ease down. And you're starting to see spot rates come down as well. And so I wouldn't say that's a leading indicator of macroeconomic growth, but I think this time when we're looking at a freight recession, it's going to be more pronounced to what the entire economy is going to be seeing.
Now, I assume you're primarily talking about trucking here, right? But there's other kinds of freight. There's shipborne, there's airborne freight. Are you seeing anything different there? And perhaps you can go into a little bit of international versus domestic.
Definitely. So what we do see that there is, so we cover trucking, of course, road, over the road, long distance trucking. We also cover intermodal rail. So I'm happy that there was no strike at the railroad, because this would have to be a much more, I think, complicated discussion around what those implications would be, because those would be quite dire.
Right.
We also do cover international. So we have a maritime market expert here at FreightWaves. And really over the past month from the ocean container market, we've seen that there's been really no shortages and challenges. And so they've continued to pose new threats to distributions to the industry. So we're seeing that the global supply chains are still really kind of in a very tricky situation. We're seeing that there's been a really big decline in container demand across most major trade lanes on the international side. And that's really helped to reduce spot rates and improve certain carrier related services and metrics and things like that. But really on the forefront, where we're seeing in the ocean side is that they're seeing a very substantial down movement and demand on the international side for the ocean side as well. So and when I think of like demand from the ocean side, I think of like that's very, very upstream, because you're saying, hey, this is before it even gets into the country. And so we're starting to see downward movement there. And I think that's very telling to say, hey, demand is really, really starting to ease at a very high level.
So I want to come back to the trucking question in just a second, because obviously the distribution community does a lot of their shipments via road, to get product out to their end customers. They're trying to cover a fairly large geographic footprint. That's why most manufacturers go to market through a distribution channel, right? Because they don't want to have individual facilities all across the country. But before we do that, I really was curious to ask you in terms of when we look at the shipboard. I know that there's been a major shift, for example, from the port of Los Angeles to the West Coast, and that's been alleviating some of those supply chain challenges you mentioned. But the real question is, isn't that what the Fed is trying to do? They're trying to essentially discourage investment, destroy a little bit of demand, so that we actually have a rebalancing of supply demand and some alleviation on the pricing front, which we are obviously starting to see in terms of both the spot and the contract rates on freight. So talk a little bit about that from your perspective.
Definitely. And I think you hit on a great point here. So when you think about the onset of the pandemic, a lot of the it was an artificial run up in demand from, stimulus being deployed throughout the country. And so you start to think, okay, there is a heightened level of consumer demand. Um, this demand is, I would say, somewhat artificially based. And so what we saw in the supply chain is that we didn't have the infrastructure in place. And there are cracks that have been in the supply chain in the infrastructure segment for quite some time. And like COVID did to many other segments, it exposed them and really kind of showcased, okay, we have a long way to go to really get to true efficiency here. And you're exactly right. We saw, the West Coast really get overloaded. We saw headlines making, major news segments of record numbers of ships, in queue essentially. Now, like you said, we see a shift over to the East Coast now. But the big thing is that a lot of some of the inflationary pressures that we saw, I think, that were built up came through that heightened demand within the supply chain. Now, you also mentioned earlier on about the increase in interest rates, and so I think it's a very, I'm so happy I'm not in Jerome Powell's position right now and having to, say, all right, this is how I'm going to fix this, because he has very limited scopes of tools to use. And so it's difficult to say, hey, let's increase interest rates to help combat supply chain issues that helped contribute to some of these inflationary pressures. And so what we're seeing now is that, all types of bullwhip effects and motion when you look at things where there's expectation of so much demand happening. You don't know what's going to be, what your timeline is. So for example, last Christmas season, instead of having a Black Friday, I think we had kind of like a black fall in a sense, because
Yeah.
there's this pull forward and so many goods, because there's this huge concern that no, we're not going to have enough stuff on the shelves. And I don't know about you, but, and not to use anecdotal experiences, but when I did my holiday shopping, and I did, I was try to be my best logistics, analytical mind and pull stuff forward and make sure I got those purchases done. But when I did my last, minute shopping, there was no shortage of things that I wanted to buy. And so from there, we saw that there was this huge glut of stuff essentially built up, and then so much stuff still on the ports that haven't come in just yet. And so that was interesting to see, because now it really gives, demand forecasters this headache. Now, this gets multiplied when you get into seasonal items, when you start to think of, okay, whether it's, winter clothing, summer clothing, sporting good materials, or, different types of industries that have, ramp ups in activity, whether it be the oil and gas industry that may be ramping up for utilities really hitting a peak season and the latter half of the year throughout the colder months in the US. And so I think, when we're looking at the what inflation has really done through the supply chain, it's going to be hard to combat that through interest rate increases. But I understand that there's just a limited tool set to be used to help combat the state that we're in right now.
Yeah, I'm curious about some of the B2B side, what you're seeing there in terms of, lumber, for example, with what we're hearing about the housing market entering a severe downturn as a result of the rising interest rate policy. On the commodity side, steel, aluminum, copper, any other products, plastics, rubber, anything like that you guys are seeing within your data that indicates a substantial slowdown ahead as well?
Sure. So one of the other areas that we have really good insights into is going to be rail intermodal. So real quick, to run it back, we have a platform called Sonar. That's our bread and butter. It's similar to a Bloomberg terminal, but it's built around freight logistics. You can have data near real time. That's our big thing, is high frequency data. So we have data as of yesterday for hundreds of
Wow.
trucking lanes, and so we can see what's happening. And we've had our time, in the past forecasting monthly indicators, and, it would be such a leg up on forecasting certain things if you have data as of yesterday instead of, a month ago or maybe a quarter ago. And so this really kind of helps with a lot of that insight to say, all right, this is the trend that's happening right now. But what we're seeing on the rail intermodal side is that there's definitely been a downshift in commodities. So we have a wonderful expert at Freightways, Mike Bowendistel, who focuses on rail and intermodal. And we've seen that there's been a substantial downward movement in rail car loads for lumber. Has definitely been downward movement. We've seen, I think there has been some downward movement substantially on steel as well. But when we start to see that downward movement in lumber, and we start to see downward movement in our measure, we have this measure that I'm in love with. It's called FOTRI, and it stands for Flatbed Outbound Tender Rejections Index. And so essentially what it measures is the capacity for flatbed trailers. And these flatbed trailers typically haul industrial material, business investment Capex, those big trailers that you just avoid driving behind, like gives you
Right.
like the final destination poles or tarp down or something like that.
Right.
But they also haul lumber and things like that. So having a tool like that you can see near real time, it allows you to see, all right, there's no substantial upward movement here. And so what we're seeing right now is that our flatbed outbound tender rejection index is still historically elevated at double digit levels.
Mm.
But we are seeing that it's substantially easing from record highs. And so we're seeing that there's more capacity growing for flatbed trailers. We are seeing that commodities moving by rail are starting to definitely ease on a weekly basis. And so that's definitely telling that us that upstream activity for manufacturing is slowing as we start to see flatbed trailer capacity really start to open up a little bit. And definitely that there doesn't seem to be, even though we did see double-digit growth for housing starts in most recent month of data here in August, that there's not that much gas left in the tank for housing construction when we look at what's moving on the road right now in terms of flatbed capacity.
So I always try to connect this to the so what, right? If you're a distributor in the room and you're hearing things like spot prices and contract prices are moving down, additional capacity opening up both in terms of rail and flatbed trucking, and it sounds like shipborne and airborne trade are probably not far off from that mark as well. So as I look out in terms of planning, right, as I go through my strategic sessions in this fall and look towards 2023, what would your advice be in terms of expectations for shipping and logistics costs overall? And as you answer that, I would love to remind the audience, feel free to ask questions using that Q&A tool. Anthony is delighted to answer them for you. But yeah, what is your look towards pricing on the shipping side?
Yeah, I think that's an excellent point there. And this is one of the reasons why I always looked at you as almost like a mentor when we work together, because when I would put together data, you always, said, all right, what does this mean for the client? What does this mean? So I think that's a great point there. And what this means is so much throughout the pandemic, the hands or the power, it was like a pendulum. It was in the power of the carriers, those that, carried out the transportation, while the shippers, the producers were, kind of left up in arms of, I'll pay whatever it is. Just please make sure it gets there somewhere near around time.
Right.
That pendulum is definitely swinging back, and it's going to be, and it's now getting into the hands of the shippers. And so I say that to say that you're going to have, as a shipper, as a producer, as a manufacturer, as a business, a firm, you're going to be able to get more competitive with those rates and driving those rates down, because what we're seeing with the opening up of capacity right now, a lot of smaller mid-size carriers and fleets are really going to be scratching for more and more business just to keep trucks running. The things that these carriers don't want to do is just idle. You don't want trucks just sitting there, because that is just, you're just, burning money essentially. And so I think from our audience here, they're going to have a better time being able to negotiate lower rates if they were in some type of contract before that was established throughout the midst of the pandemic. Maybe they just carry conditions somewhat similar through to the next quarter. These upcoming quarters, you're going to be able to have much more, I think, pricing power on your side than what you were having over the past couple of years.
So if I hear you correctly, it seems that the advice is reassess where you stand in terms of your contracts for your shipping rates, look towards exerting a little bit of pressure perhaps on your logistics providers, and say, look, if you want to keep my business, because there is a lot of capacity out in the marketplace, you got to give me a more competitive rate, which is obviously welcome news in a high inflation scenario. And when companies, particularly distributors, are really squeezed on the margin side. There was an interesting question that came in that's related to this. Raymond Prezillo asks, can you please address the driver wage projections for 2023 and driver supply? Any insight on that?
Sure, certainly. So I think we're looking at driver wage. The large carriers, they're going to be, competitive, and it's always tricky when you look at driver count, because for so long the industry, if you ask anyone else in the industry outside of freight waves, typically they'll say that there's a driver shortage. Now, I do believe that there is an aging population for drivers. Not enough younger people know that this is an opportunity, a career that they can go down that could be very lucrative for them. But I do expect wages to come down or moderate essentially for mid-size and smaller owner operators, just because we're seeing that there's just so much growth in transportation capacity. Now, the driver count is interesting. So what we see at FreightWaves is that there's more so of a retention issue. So you see that there's just high turnover for drivers, especially company drivers. They can switch hats at a moment's notice here, and that's great for them because there's so much that they get, the short end of the stick so many of the time. So the least that they'll be able to do is just like, you know what, I'm just going to switch. I'm going to switch. I'm going to switch to find out where, their best bang for their buck is going to be. So really I'm anticipating that there's still going to be that ongoing driver retention issue within transportation as we get into 2023. But I am expecting those wages for mid-size and smaller fleets to moderate. Larger operations, especially if you're a company driver for, Walmart, you're going to be just fine. Target, you're likely going to be just fine. But those smaller or larger carriers that are just, strictly carrier focused, they're going to be operating with contracts that are going to be declining. So I do anticipate that driver wages will be starting to moderate pretty substantially as we get into 2023.
So it sounds like there's going to be opportunities to look for other ways to offset costs, right? So if you have been paying a significant amount for new drivers, first of all, potentially the expectation is that there is a little bit of disinflation on the wages side. So that doesn't mean that wages go down, right? They just are not rising at the same pace as they were over the last couple of years. If you are looking for a potential new supplier of logistics and freight, you might be able to leverage the kind of lower costs to increase or at least maintain your profitability. So that's a really interesting. For the bigger companies, like the big retailers, as you mentioned, look for less change, right, than the smaller and the medium size. So it seems like that's where the opportunities will be. The retention issue in particular kind of caught my. Typically, when you switch roles, when you put on a different cap, right, you're doing so for more money, in particularly in those positions, right? So that's a notion that really leads me to believe that they're going to try to maintain their wages by shifting from company to company. So I think that the prudent advice would be assess the stability and the retention rates within your shipping partners in order to not find yourself short of capacity all of a sudden because they can't get the people. Would you agree?
I definitely agree. And I mean, when you look at this industry, Alex, you might be shocked that it's not unheard of for a carrier to have over 90% turnover. And that just sounds absolutely wild when I first heard about it. Just like, wait, what? That almost no one sticks around for over a year or something like that. And so it's definitely going to be one of those things where, carriers, mid-sized carriers, even larger carriers, they do, certain incentives, sign-on bonuses, lease to own, things like that, all kinds of types of benchmarks to try to say, hey, we want to retain you. A lot of times when it comes down to the driver, wage is a big part of it, but there's so many things that comes down for the driver. It's just like they want to be able to we have this term called detention. They don't want to be in detention, waiting to, a load to get hauled or loaded up and in queue in a line for so long. They don't want to have ambiguity. Some drivers, I think, would even take a slight pay cut, if they had more transparency on how they're going to get paid, and their terms of payment. A lot of times there's just so much confusion of when their payment's going to be coming through. When you see this happening for owner operators, this is a huge headache for them, because they need to know they're not a company driver. They don't have a fixed income. They need to know, all right, when am I getting paid? How's this going to work out? What are the terms here? So it does come down for drivers, or just like a different mindset overall. Just because you think about it, they're in this truck, they're almost like their own island. They are their own operator, and they just want to be able to do their own thing, have their own freedom. At the same time, know what's happening. They want that transparency. And the big thing that drivers always get down to is just say, hey, there's no transparency in this industry. And that's one of the big things that FreightWaves came around for, is just wanting to bring more transparency to the market, because the supply chain is so fragmented. And so it always comes down to the drivers really kind of having the short end of the stick, like I said earlier. And you're definitely going to see a lot of turnover, I think, over the next year or so, as we always seen in the trucking community. But as you mentioned, checking out what that carrier's track record looks like. There are plenty of great resources out there to see, is this a fly-by-night ghost carrier that just kind of popped up and has a long history of, under providing their services, or is this going to be someone that's like a gold standard, like a Old Dominion or something like that, that's really has a long track record of being able to provide quality service.
I love the idea of more transparency. Obviously, one of the key pieces of advice that I've always offered business decision makers is be data driven, right? You need to understand what's going on in order to make educated decisions. So this is very much in light with that. It seems that we have touched a very important point here with talking about freight and drivers. So we have a group of questions. I do want to make sure we talk about both inventory expectations and general investment considerations in terms of Capex. But let me ask you these questions, and if you can kind of answer them fairly briefly, so we can make sure to cover the rest of the content. So the first question comes from Joseph O'Brien. As a distributor, we have several manufacturers that have been charging freight surcharges between 3 and 9%. We pass this surcharge along typically to our end user customers. Do you think that such surcharges are still reasonable?
I think that one's going to be one that's going to be slower to erode as we continue to move into 2023. But I do think that it's going to start to come down from that 9% and ease down closer to that 3% as we get further and further into 2023.
Okay, so plan for lower surcharges over time, but not an overnight flipping of the switch, essentially.
Right.
Okay, makes sense. Thank you very much. Next question from Jeff Landman. Is part of the new capacity from air freight capacity coming back on board and vacating ocean freight and truck space?
So we are seeing a substantial amount of investment happening in air freight right now, air cargo. We're seeing a lot more companies take this as a much more serious segment, even those that are typically, commercial carriers. So we are starting to see that kind of starting to come on, but it's not enough at the point just yet to be a substitution, because it's still going to be those, timely goods, sometimes more sensitive goods. So those are sometimes even a lot more pricier goods. So I don't think we're at the price point just yet, or the capacity level just yet, to say that it's going to start to erode that enough. But the lack of demand that we're seeing right now for ocean carriers, I think, is really going to start to draw down a lot more capacity and bring rates back down.
Yeah, I mean, it makes a lot of sense, right? Air freight is typically much more expensive than if you look at ocean freight or rail or even on-ground trucking. And so the additional capacity there is good for, like you said, for specific items, but the general eradication of demand that we're seeing is the bigger driver in freeing up more of that capacity, if I understood you correctly.
Correct.
Yes? Excellent. The last question here before we move on from Dmitry Kmel. He wants to know if this is only the US picture that we're talking about, and do you see data for other geographies as well? And are there any differences or similarities there?
Sure. So we are starting to see we have our bread and butter is going to be here in the U.S. We're looking at tracking transportation supply chain trends, but we are getting a little bit more into Canada, a little bit more, so a little bit more into Canadian markets. We don't have where we want to be just yet. In terms of international, a lot more of our data sets are going to be about what's coming into the country from China. That's going to be worse, and where a lot of our imports are coming in. So from an international level, we have visibility on our ocean freight side to see, all right, where is their demand coming from, where are our imports coming from, I should say. And what we're seeing, of course, with one of our largest international trade partners, China, is definitely starting to ease substantially right now.
And is that, in your opinion, is that more related to kind of the COVID closures that they've had, or is it more reflective of just a weaker macroeconomic environment?
So that was a huge one initially, was the zero COVID policy. And I think that really kicked off and kind of allowed for this space of, all right, we're also seeing demand come down as well. And we're also starting to see a lot more initiatives of that mythical nearshoring that we've heard so much about Mexico really going to be the next explosion of growth and stuff like that. We are starting to see some investment really starting to happen in Mexico to really kind of boost some domestic production in North America. But a lot of it did start around with the zero COVID policy and then carried over as we start to see a start to erosion in demand as well.
So Mexico is a really interesting point that you bring up. Are you actually seeing volumes of freight from Mexico increasing to support this idea that we are more and more reliant on producing goods in Mexico and bringing them into the US?
So I haven't seen anything super substantial just yet, but we are seeing that there is a fair amount of investment going on, especially in the automotive space happening in Mexico. There's also a fair amount of e-commerce starting to happen in Mexico as well. And so that is an area that I've been having my fingers crossed and watching over the last 8 or so years. But we are starting to see substantial investment in cross-border infrastructure. We're starting to see more logistics companies making a move to, Laredo and different parts of that corridor to really kind of boost relationships and business, I think strategic business partnerships out there as well.
That's fascinating. So you said a key word in there, investment, right? I want to shift gears a little bit and talk about, this. We discussed the implication in terms of interest rate policies on certain elements of both the manufacturing and distribution worlds. We also have seen, based on my observations, that companies are looking to draw down inventories, particularly with the anticipation of weaker demand, right? They don't want to have high inventory holding costs, so they're looking to sell more stock from what they already have rather than continuing to resupply from the manufacturers. And perhaps, I'm just pontificating here, but perhaps that's partly why we're seeing lower freight demand, is they are drawing down some of those inventory levels. Is there anything that you can talk about either on the inventory side or on the investment side that really stands out to you from the data that you track?
Certainly. So for our platform, I'm thankful that we have a lot of great partners, one of which I'm incredibly thankful for is with a number of institutions: Colorado State University, Arizona State, University of Reno, Nevada, Rochester Institute of Technology, and quite a few others. But mainly a professor at Colorado State, Dr. Zach Rogers. He helps put together this index called the Logistics Managers Index that we have in Sonar, and this also broken down as the LMI. And it's a monthly index that's similar to the PMI, wherein anything over 50 is indicative of expansion, anything below 50 is indicative of contraction within manufacturing. But this one is going to be within logistics. And so the other similarity is that it has different subcomponents in it. And so he has a subcomponent that's the LMI for inventory levels. And so what we saw at the inventory levels is at a 67.6. So very much above that 50 threshold for growth. And so one of the things that he's seeing is that there's still an ongoing expansion in inventory levels. And we're starting to see that inventory prices did come down ever so slightly, but inventory prices on a scale for the LMI is at a 75 percentage point reading. So it's still very much elevated, well above that 50 threshold. So we're seeing that inventory levels are still indeed growing. We're seeing that warehouse prices are still very much elevated. And so this gets really tricky because, you don't want to draw down all of your inventory because you don't want to be stuck in that bullwhip effect. Once again, now you're stuck without or you're left without all of the goods that you really need to have in place. And one of the interesting things that we also saw, I think, on the PMI report was respondents really coinciding with saying that there is almost a just in case pull forward of certain inventories for manufacturers, a lot of businesses pulling goods forward. And I start to also consider how much of a pull forward is happening potentially in capital investment, because there is this expectation that interest rates are keep going up, and if I'm going to not buy straight cash, and I'm going to leverage credit, maybe I need to make these investments in Capex before it gets more expensive as interest rates continue to go up in the future here.
Yeah, I mean, no one has a crystal ball, unfortunately, right?
Yeah.
We all wish we did, and we all wish we knew how high the Fed is going to go with their interest rate increases. And if you look at kind of the pundits, the consensus opinion is they're basically saying we're not quite done yet. Depending on who you listen to, maybe another 0.75%, maybe as much as 1.25%, or even slightly higher. So, with the latest move by the Fed, we're between 3.75% and 3.25% on the federal funds rate. That does, of course, reflect a 3% higher cost of borrowing relative to where we were before they started moving here. So it's this trade-off that I think a lot of companies are having to consider. Do we take advantage of the rates now before they get higher, or do we face the slowing demand and kind of tighten our belts a little bit and say, well, they're already high enough, and I'm not sure that I should be investing in certain elements, particularly durable, long-term, expensive Capex type of projects. What are your thoughts on that?
Yeah, I think that's the tricky part, and that's why I'm thankful I'm not a demand forecaster for some of these companies that are having to really get into some of their specific fields of how to plan around demand for certain machinery and different parts and things like that. My expectation is that or our thoughts around it is that we have to be careful around that pull forward of inventory, because within the supply chain, as I mentioned earlier, it goes in these wild swings, but it's always kind of late to react. So we saw that so many people entered the market throughout the ramp up in the pandemic because they saw that there was just such a need for transportation. Rates were skyrocketing. Hey, my cousin's a trucker, he says it's a great job, let me get into it, or things like that. There will be more entrance into the market until there is just absolutely nothing to be had here. And so I think you'll be in a much more advantageous position potentially if you weren't as aggressive with the scarcity mindset that I need to pull forward as if it were still in the midst of the pandemic time. And so I think a lot of distributors and those looking to make Capex investments, I don't say they can rest easy by any means,
Sure.
but I certainly don't think that they're going to have the same issues right now trying to pull forward certain orders. Now, there's still going to be backlogs, there's still going to be delays, things like that. But I think we're a far cry from where we were, of course, 2 years ago.
Yeah, and Dan Spence has a related question here. He wants to know if you have any opinions of whether inventory is growing because it needs to be, because there is that sustained demand, or is it because it's already in the supply chain? Those orders have already been placed, and as a result, they're just taking things that they ordered maybe 3 months, 6 months, up to a year ago, right? And that can't really be stopped. What are your thoughts on that?
Yeah, I think that's a great thought, and I think we've seen some of that. We've seen some cancellation of orders come through in certain subsegments, but I do think that there is uh, that just in case mindset that is pulling forward a lot of current inventory demand right now. But we are starting to see that there is on the other side of it though, some eroding orders. So I believe the PMI, the latest new orders numbers did go into expansion territory to just over 50, 51 or something like that, while backlogs are starting to grow a little bit more. But I do think that business conditions are softening, especially when you start considering other Fed manufacturing indices like the Philly Fed Index, the Empire State Index, and contraction territory. That there is a substantial softening right now in business conditions. So I do think that the demand is easing. But I do think that there are just still some orders coming through the end of the year because some customers just feel like they may. I think there are going to be some orders that are going to be pushed back into 2023 if they're not all outright just canceled.
Yeah, I think it's quite prudent to advise caution at this point to,
Mhm.
as a minimum, reflect the changing landscape from where
Right.
we were 6 months or a year ago. There is not the same kind of A, scarcity, B, supporting levels of demand. So, this FOMO mentality, right? The fear of
Yeah.
missing out, where companies were placing extra volume orders because they didn't know when they were going to get the product and they wanted to pre-buy in advance, anticipating some potential future activity. That needs to really be moderated in the face of a clearly slowing economy, a great deal of uncertainty related to the war in Ukraine, certainly from what China does in the face of COVID, from, we've got the political cycle ramping up here in the United States. There's always some interesting realities in terms of business decision-making and conditions that are related to that landscape. So as I can contemplate all this, it seems that the key message that we're trying to deliver to the audience here is that you've got to continue to monitor developments and adjust, right? Don't make these big, as you said yourself, whiplash moves, right? Don't all of a sudden cut off your ordering or surge the wages that you're paying people, but more gradual, tempered approach. Use the feed-in data to inform your decisions and react as conditions justify, right? So when we look at the key element that I think has been kind of reflective of all of these developments that we've talked about, which is inflation, right? We do see some moderation on the side of pricing. We talked about it in terms of freight. We talked about it potentially in the trucking market in terms of driver wages and things like that, right? So we're not saying inflation is going to turn into price declines, but certainly moderating growth. As we look out to the future, and when you look at the conditions in the freight markets that you track, is there any specific advice that you would offer based on some differences or similarities that you see between the different types of freight? Should companies be looking to maybe make a change from one type of sending product to another as a means of really recognizing some of those cost savings?
Definitely. I think when you're looking at over the road trucking, good old fashioned trucking, the capacity is growing there. And if you traditionally, maybe didn't utilize the spot market and you were just, all right, we need a contract in place. You can still have your contracts, you can still honor those, but I think on the flip side here, you can see that there's going to be a lot more opportunity for lower prices on the spot market as we continue to move into the end of the year into 2023. And I think, and now it's going to be a bit of a headache, but I think for those that are looking to pull forward any type of demand or any type of goods, to kind of start splitting some of those out. So if someone was saying, all right, we need to pull everything forward or just increase everything by 7%, 3%, whatever it might be. Start breaking out the different categories. All right, saying, all right, there's still an incredibly and incredible, difficult time getting some electrical components. And, there might be an easing in this segment, but this segment is still, very much tight, and treat them differently and being able to be more efficient from that aspect of seeing, all right, what's still in really tight demand versus what's kind of starting to alleviate. What can I start to push the brakes on a bit and say, all right, we can start pausing this, but really keep our eye on this small component or this subsector because demand is still very high here and these parts are still tricky to get.
Yeah, I really love that advice. I'm a huge believer that the devil is always in the details, right? And so companies absolutely need to realize that broad-based decisions need to be broken down and compartmentalized, like you said. And it is very much a product by product or category by category type of decision set that they need to be making in regards to planning for the future from a logistics capacity, from a freight capacity, and from a demand versus supply consideration perspective as well. We've got a question here from an anonymous attendee. He says container prices are still double what they were pre-pandemic, and that is why we're surcharging customers. What's your outlook for container costs through year's end and into 2023?
Certainly. So I am not as deep into the container segment as our market expert here at FreightWaves, Henry Byers, is, but he does say things, like that really kind of brings to mind that today's global container market is still very much volatile and there's a high dynamic to it. So it's still a wise decision to monitor near real-time data sets closely and pay attention to any potential obstacles that might, pop up. You talk about, weather events, typhoons in East Asia, still partial lockdowns in China that are happening right now. There are different warehouse and container yards that were closed over, I think 2 or 3 weeks ago. So it's worth noting that. And really, when we're looking at the container prices, still elevated, but I do think that they are going to continue to decline as we get into 2023 for sure. But being able to monitor those near real-time data sets and see, all right, what are the current events right now that's happening? But I do see and do anticipate that we see the TEU vessel capacity from China to United States. We are seeing that there is, a substantial easing kind of happening in effect right now.
Yeah, and I would second that based on my own observations. I mean, there are two concepts in play here. Number one, obviously, we do hear about the additional capacity coming online in terms of the containers ordered. The containers are going to be coming into the marketplace. We couple that with weakening global macroeconomic forces and lower demand. That creates a very basic economic principle of downside pressure on prices for those same containers. I think that there's the other element that the question alludes to, which is, yes, prices are starting to come down, but if you look at not just containers, but really across the inflation spectrum, we have food prices, rent prices, durable, non-durable good prices. They're starting to ease, but year over year, in many cases, it's still double-digit growth. Now, it's not as exacerbated as it is in the container space, but I remember when we were looking at this data, 6 or 12 months ago, and the cost from shipping a container from Asia to the US was something like 6 to 8 times what it used to be before, and similar for Europe, right? So although it's starting to ease a little bit, we're still extremely elevated. To me, that's a key signal to all companies, manufacturers, distributors, whatever role you're playing, that you have to keep your eye on the bottom line. You have to look at profitability. You have to consider the decisions that you make, both in terms of purchasing future goods and selling the goods that you already have in inventory, with the calculation of what did it cost me to get this in? What is it going to cost me to get this out? And am I still at the profitability level that I want to be? Anything that you'd like to add on that angle?
No, I think that's spot on because there's so many different dynamics when you look at it, like demand forecasting and how to pull things forward. And as you said, the devil's in the details, and you really kind of got to get in there. And so I think the more strategic you can be about how you evaluate data and not relying on, historical norms and trends and things like that that have been holding true, over the past X amount of years. Like you said, although there is an easing happening, we're still very much in a very dynamic market right now. So being able to say, all right, this happens at this time of the year, but I know conditions are still a little bit different. I have to plan accordingly. So don't get too stuck into, all right, this is how it's always been done. This is how it always will be. This is going to be, the new normal is going to be the old normal. For example, I hate using the term new normal, by the way,
Yeah.
but I think you're spot on with that.
Okay, so one other comment that I had here, was that from a profitability perspective, right? You also have to look at it on a customer by customer basis, because the same products sold to different customers under different set of circumstances. You might have one that's quite profitable for you and one that's not. So it's not just a product consideration. You have to really look at it at the customer level as well. As far as warehousing, that's the last kind of point that I wanted to touch on. We've talked about inventories and kind of what we're seeing there. We're talking about freight. One of the major issues that distributors were certainly facing is warehousing costs were through the roof. Is there anything that you see on that front that might provide some insights for our audience?
Certainly. So yeah, warehousing is a tricky one because as we mentioned earlier, it's still very much elevated. So when we look at things from the LMI perspective, so that Logistics Managers Index, one of the things that's really interesting from that index is that there's a future expectations component from his respondents, and from the most recent report, it says that future expectations suggest that there's going to be a continued growth rate around 70.8% or something around that mark. So I think it was 70, maybe 71 percentage points, but it was in the 70s for the expectations of where warehouse prices were going to go. So that therein still above, well over the 50 threshold. So shows that there's a slight downshift there, but still very much elevated over the next 12 months. So warehouse prices continue to grow significantly faster at a really increasing rate. I think the big thing that he did note that we are seeing right now is that it is increasing faster on the upstream side versus downstream. Upstream being more wholesalers, distributors, things like that, versus downstream, closer to that retail market, things like that. So we are seeing that warehouse prices are going up, and they're increasing I think at a faster level upstream for more so than downstream right now.
Interesting, very interesting. Well, I certainly think we've given our audience plenty to think about. If I can summarize here, yes, we're clearly in a weaker economic state, whether you want to call it a recession based on the GDP metrics, or if you want to look at it in more detailed, granular state and recognize that there are some industries that are still very much in growth mode and others are already feeling that contractionary activity, depending on the market that you play in. We've got some positive, encouraging signs from the data that you track at FreightWaves in terms of both spot and contract pricing on trucking, on rail, on shipborne trade, and on air freight. So that's, to me, a very clear call to action for the distribution community to reassess where you stand in terms of shipping. Don't adopt this, well, we've renegotiated our contract once a year, and that's what we've always done, and so that's what we're going to continue to do. No, be more dynamic. Look at it on a more regular basis, be a data-driven decision maker there. So, the inventory question to me was a really interesting one. We do have some indication that's starting to slow, but inventory levels are still very much elevated. Warehousing pricing, all very elevated. This index that you mentioned, the LMI, is that something that the public can get access to somewhere? Is it published somewhere, or is that proprietary?
It is. So of course we have it in our Sonar platform, but you can also go to the-lmi.com and that's updated monthly. And it's really a very cool index. Dr. Zach Rogers, an underrated voice in the supply chain industry from my perspective, but definitely I recommend that one to give it a read.
Fantastic. Well, any closing thoughts before we let our audience go?
I don't think there's anything that really jumps out to me. It's just funny because the easing conditions, I think, and transportation capacity is, good news here. But then I have a call a little bit later that's going to have, I think, some carriers, and I'm going to have to say it's going to be bad news for them.
Right.
Um, but
That's right.
I think as we continue to move into 2023, of course, it's going to be continued shifts in dynamics, as you mentioned earlier, being able to watch those data set closely, utilize near real-time data sets like we have in Sonar. I think, and of course, measuring those details that we were talking about earlier, you're going to be really preparing for success, because as we know, an economic downturn doesn't have to be an economic downturn for you. You can still find ways to have growth and prosperity during these times.
Absolutely, absolutely. It's all a matter of perspective, and I'm certainly very grateful to you, Anthony, for coming on the show, sharing your perspective with our audience. Thank you so much for being here. We really appreciate you and your insights.
Thanks so much for having me. It's been a blast.
Absolutely. Well, we're going to just a quick look at what we've got coming up. There's a webinar on September 28th at 12 Eastern on the Wholesale Change Show. Alex Tomey is going to be talking about the different elements that are key from a chief merchandising officer and senior vice president of global industrial perspective. That's going to be brought to you by Epicor and Bloomreach. We've got another webinar that we'd love to have you join us for in terms of how distributors use CRMs today. That's going to be moderated by Mike Marks, who's the founding partner at Indian River Consulting Group. That's going to be brought to you by Proton AI. And as always, we encourage you to reach out to either myself or to Anthony if you have any outstanding questions from today's show. I just want to say thank you again for being here. I hope you got some value out of it, and I look forward to welcoming you on the next episode of The Discerning Distributor. Thank you so much and have a great day. Take care.